3 days in a row to the downside, 3 days in a row we close the day to the upside. What does that mean and how does that impact this posture? How bearish are we right now? And what can we expect the rest of this week with a lot of news on the calendar from an earnings perspective, from an economic perspective by the end of the week? So I'm going to break down the current market posture, how that relates to what we've been expecting and what we continue to expect going forward. We're also going to take a look at a trade of something that where we can speculate on something that we anticipate will bounce based on its technical pattern. That hasn't bounced yet, but we anticipate it will because of what we're seeing. So let's go ahead and get started. Today is Monday, October the 8th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight. Glad to have you, especially those who are new. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel. Mouse over this logo right here, then click the red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That tells me two things. It tells me, number one, you got something out of our video tonight. Number two, it tells me with one click, you want me or Brandon to do the video tomorrow. Really easy way to tell us you liked it, you want us to keep doing it. One click, you can do that right now while you're watching. Also, while you're down there, comment on anything that stands out to you from tonight's video that you want to get our take on. Join our daily Market Outlook email list. There's a link popping right there in the top right corner. Click that link to subscribe to our list. Very easy way to do that. Follow me on Twitter for more content like this throughout the day, in short form, obviously. And join our Market Outlook community that we have on Facebook, on our Facebook page. All right, let's take a look at the market forecast on the S&P 500 first. I've got a couple of Fibonacci lines drawn here. The green one is the current intermediate run that we're on, this green shading that we've got, dark green shading. That we do, and light pink. So we don't have any dark pink. That's when the intermediate run ends. So here's one intermediate run. Here's the one that I've got. These two intermediate runs make up the current long-term market sentiment rally, with the orange line getting up from below 50 into the upper part of the chart. So so far you can see that we are pulling back right now towards what is the 38% Fibonacci retracement of the current intermediate run, which is right around the area of the 23% Fibonacci retracement of the long-term run. So when I say there's a lot of support in these areas, there's a lot of support in these areas on these pullbacks. So I'll get rid of that now so it doesn't clog things up. And you can see this one here. Let's make it a little easier to see now. But you get the idea, and that's the point I wanted to make. Is, as we pull back, you can see that at the end of the day, the past three sessions, the bulls have come back and rallied up. That's why we've got the long lower shadows for 3 days in a row. The intermediate line's still falling, so we're still pink, but we're not dark pink. So the intermediate run hasn't ended. I'm going to venture to guess that unless we break back up above 2,900 pretty sharply, we're probably going to get the near-term intermediate line pulling back below 50 in another day or two. But you see the short-term sentiment is not oversold. So similar to this pullback, right? We had this pullback here, brought the intermediate line down below 50. Excuse me. The short-term sentiment never got oversold. I mean, there was a point where the momentum line dropped pretty sharply, but that was the day we bounced off. So we haven't even had that. We haven't had the momentum line fall nearly as sharply as we even had on that one day, much less on this day that kind of sparked the beginnings of the bearish pullback, right? We had the red flag. And again, if you didn't check out my technical analysis class on the website on Friday for premium subscribers, check that out, because I went through what all the signs of weaknesses are. But we had that sign of weakness, we had this sign of weakness on the near-term line, and we continued into that pullback. We've had lots of signs of weakness over the last couple of weeks that have told us that this kind of a pullback was coming. Whether, nobody knows to the extent or how fast or when, but we can prepare for it, as I have been talking about in these videos. But we are heading towards support. In fact, the blue line is actually the old high point from back here, which is right in between the 23. So, it's going to have a hard time dropping here. You see the Dow Jones Industrial Average. It's pulled, it's sitting at some support in this area, that near-term low point here. It's holding so far and bouncing up at the end of the day. It's finally got a weak bearish posture, not bearish enough to end the trend. See, we had a weak bearish posture there and we bounced. We had a weak bearish posture there and we bounced. So according to that precedent, we can expect to bounce from there. The Nasdaq has got the dark pink shading, again, without the strongly oversold short-term sentiment, sitting near support. We kind of broke through it a little bit today, even though we didn't close below the low point. We got another long lower shadow right near this old low point here. And then finally the Russell 2000, which has been the most bearish, again, trading, and we even had a cluster today again, and avoided a cluster again because of the long lower shadow. So it's like 3 days in a row that we avoided clusters by the end of the day, even though we had them at the beginning of the day. So, and it's more strongly oversold on an intermediate basis than all of these. And you can see again, it's finding some support at these old intermediate high points here, and what is actually the when you draw these Fibonacci lines and pull it out over to this low point, which is where the market sentiment run started, you can see that 50% Fibonacci retracement. Whoops. This one, the horizontal line, is sitting right at that old high point over there. So there's some support here that it's going to have a hard time getting below. And there's 1600, big round number right below that. So it's bearish, but as I mentioned, I don't expect us to bounce tomorrow. We could, but I don't expect us to. I expect this week that will trade towards the lower end, of last week's range, until then we'll bounce off of these support levels that all of these major indexes are sitting around right now. The Dow is the only one. I mean, it's the one that still hasn't had enough of a pullback yet. If we bounce with some of these small cap stocks first before the large cap stocks kind of take control later, we might be able to get some relative weakness, not necessarily bearishness, but weakness that can help pull this back. Because that's what we really need to see, is to see this intermediate line get below 50 like it has for the other two. This would be number 3, and then the Dow would be the 4th one. That would set us up for a better bounce like we had over here in July for the next couple of months, heading into the seasonally bullish time of year. Alright, a reminder for those of you watching the video on the blog, scroll down here below the video, you can do that right now while you're watching, and click on this heart right here. That tells me, and then eventually click on that like button over here on the right. That tells me you want me to do the video, or you want me and Brandon to do the video tomorrow. You want us to keep doing these videos day by day. Click on this image, it takes you to your Facebook page, and like the Market Outlook post there. Again, one click tells us you want us to keep doing these videos. And then thirdly, click that like button right there. So those 3 clicks you can do right now. That tells us that you got something out of these videos. You want us to keep doing it. It's our best way to get feedback from you. So the more numbers we see here, the more we know that you're liking these videos and you're getting something out of them. Kind of tells us to keep doing them. On a long-term basis, you can see we still haven't closed below that 50-day moving average yet, even though we're trading right there, right at it. The red arrow will appear when you close below it, and that will typically coincide with a pullback on the intermediate posture. You can see the Dow is not as close to it, so we're not as close to that bearish posture yet, the stronger bearish posture with the dark pink shading. You can see the Nasdaq has got it, and the Russell is actually trading closer to 200, similar to what we've seen before. So more support in this area, including now the 200-day moving average, that will keep the Russell from dropping too much further, and like I said, potentially give us some relative strength as we bounce before I expect large cap stocks eventually to take that relative strength back and head higher, eventually as the dollar heads lower. We'll talk about that more here in just a minute. If you look at the 3 green arrow chart, you can see, first of all, we got 3 red arrows. Of course, let's take a look at SPY here really quick. You can see the volume today. Again, another day of strong volume. We've had a couple days of 100 million. We're down now to 87 million. Today's range has dropped down. These other 2 days, this day was 3.5, including a little bit more of the gap. This one was 4 points without a gap. And now we're at 2.72. So we're starting to come down in volume. We're starting to come down in the trading range. If I take a look at the chart here, you can see 87 million shares trade. Oh, excuse me, let's go to the 2-line version. That's what I wanted to show you first. You can see the MACD has dropped below 0. Stochastics has dropped a smidgen below 50. Again, this is the last time we did that. We had the intermediate pullback, and that's what I'm expecting. You don't see that yet on the Dow Jones Industrial Average. You're close. You're right at the 30-day. The MACD and stochastics are still high. Of course, on the others, on the NASDAQ Composite, you are below both of those, and the Russell 2000, you can see significantly down. So again, we're as bearish right now in the small cap stocks as we were back in February. I mean, even more bearish than we were in April, and we had some pretty good bounces off of those levels. So we're pretty significantly bearish here, potentially too bearish, right? That we've gone down a little too far. If I were to remove that drawing and draw the Fibonacci lines instead this way, you can see we've dropped down to the 162% Fibonacci retracement of that rally off of that low point where we broke out of the triangle. We pulled back to the triangle. We broke through the triangle. We broke through the other side of the triangle, the triangle being right here. And now we're hitting Fibonacci again. Another layer of support for the Russell 2000 here in this area right above 1600. So unlike the previous 2 days where you had these late day rallies right at the very end, these other 2 days basically got you to the midpoint of the day. Today's rally, even though it produced a new 4-week low point here, today's rally got you back up to today's high and got you pretty close to yesterday's low, pretty much right at it, yesterday's low point there. So a little bit more bullish. So again, lower high, lower low, closing in the middle of yesterday's range, which is where Friday's rally got us to. So not as bearish as you would expect. I would expect us to continue to trade up and down in the lower half of last week's range. So, I mean, you see how wide last week's range is essentially the 4-week range. A little bit more up to the high there, a little bit more down to today's low. But the reality is last week's range is pretty much this week's range. You can see when I go back and look at the weekly chart for the SPY and look at the Hakinyashis, you can see how bearish that candle is. Similar again, there's the last intermediate pullback we've had. So looking very similar here. The open is at 290.17. So that means we have to go change this line here to 290.17. That's the open for this week's Hakinyashi candle. Remember, the open is the midpoint of last week's body on that type of candlestick pattern. So, again, that's right around the midpoint. So I expect that we'll trade in the lower half. We might go up here, we might come down a little bit more, but we'll trade in the lower half of last week's range. Again, breaking in the upper half will be bullish again. That will be the time. That will be one indication that we're bouncing back up and heading towards the upper half of this 4-week range. I showed you the volume at 87 million. Again, it's above the average, but not as bearish as it's been. It's starting to come down. The range at 2.72 is above the average, but not as bearish as 3 to 4 points. So the volumes and trading ranges are starting to come down. The volatility index started the day higher and got up to 18. Again, comparison to the last intermediate pullback. There's your last intermediate pullback. We got up to 18 there too. But you can also see, like we got there, long upper shadows in the VIX. We got long upper shadows the past few days on the VIX. And from a relative standpoint, we are in bearish territory now on the VIX. We're above the neutral zone of 90 to 95. We had closed below it Friday and back into the neutral zone. Today we stayed above it. So we are bearish. Extreme is above 105. And so again, we are in bearish territory, and another reason why we expect that we'll probably trade around here, maybe 15 to 18 for the next few days as we stay down. I don't think we'll go too much lower. Of course, anything can happen. I don't think we'll go significantly lower. I think we'll have some ups and downs towards the lower end of this range that we've been in this last week. So to summarize, especially for those listening for the first time and may not have understood all the jargon there, to summarize, I'm still bullish on a long-term basis. We are getting a little bit of a pullback now, what's called an intermediate pullback, which is like exhaling. We take a deep breath in, we take a breath out. That's how we live. That's how the markets stay orderly. When we get disorderly with too much of a inhale, then the exhale gets too big and people panic, right? So we are right now in the midst of an orderly exhale, and there's a lot of support that will keep us from falling right now too much further. I don't expect us to bounce yet. I do expect us to bounce eventually off of a low point around here. But I don't expect it to bounce yet in the short term. There's still some bearishness in terms of volume and where volatility is. But I think the worst of the selling is behind us in terms of the bigger moves that we've seen the last couple of days of last week. So with that being said, what do you think? Do you agree with that or do you disagree with that? Click that link in the top right corner of your poll and then click that link and then it opens up the poll. Then click either agree or disagree. If you click on the disagree, scroll down to the bottom to the comment section and type in what you see that either suggests that we are going to get some more selling here or that we're going to bounce earlier than what I even think we will. So let me know what you have on your radar there in the comment section below. All right, now let's talk about what's driving the price action today. And really, there wasn't anything on the economic calendar in the U.S. And obviously, the earnings season hasn't started in full yet. The earnings will pick up this week with the big banks coming out with earnings this week. And we do have some economic data coming by the end of the week, some inflation sentiment data, PPI and CPI coming in as well. So things will pick up, but today with a holiday, especially in the bond market, it seemed like the market just kind of kept going, especially over in China. You see, in fact, when you look at the foreign markets here, let's look at the foreign markets here really quick, especially the big ones. China really struggled. China off of its lows, but I mean it's at 3-month lows. I mean, look at all these. Germany has 3-month lows. Italy with another oversold cluster. India with another oversold cluster. South Korea at its 3-month lows. Bounce up in Russia here above its moving average. Everything is off of its lows today, but you can see all the big gaps to the downside. France, UK close to its 3-month lows. Canada bouncing up. The only really big mover that's really breaking out is Brazil. Brazil, which has been such a big loser here. You can see, look at the decline. Look at that big breakout. This is significant, and now is opportunity to really start to move higher. This is the market forecast on a weekly chart. So, as it moves higher, that's multiple weeks of strength in Brazil. There's some opportunity, whereas Germany, UK, and France all struggled, in Italy, these European developed markets. In fact, when you look at the asset classes, let me pull up the asset class chart here for L. You can see gold. The dollar was up all day long. Dollar started up the day strong and stayed strong. It did give back some gains as stocks rallied. You can see U.S. stocks here in black, emerging markets here in brown. Those two finished the day positive or higher, but developed markets lagged behind. And then in brown, right where my cursor is, this one. This is small caps. So small caps had a small, off of its lows, but small loss for the day. And you can see bonds started the day relatively strong and even had a gain early. Again, remember, they're on holiday. The bond market is on holiday. Doesn't stop the ETF from trading because people can buy and sell the ETF on expectations of what might happen tomorrow when the bond market actually opens up. But you can see it finish the day with a loss below the corporate. You can see corporate bonds being down too. So a risk-off day early with dollar, bonds, and high yield outpacing equities and gold down here at the very, very bottom because of the strength in the dollar. But then a risk-on by the end of the day with all these equity assets, especially the emerging markets and especially U.S. stocks, large-cap stocks, bouncing into the end of the day. You tend to get moves like that, technical moves, when you got days when there's nothing no real driving force from a macro or a news event. Let's take a look at how the sectors perform. There's your sector rotation, staples, real estate, and utilities. So on a day where bonds were actually down, yields were up a little bit. Again, technical because of how bearish they were last week, following through with some of that early today with nothing driving the market today from a fundamental standpoint. The stock market suggests that there could be a bounce coming in TLT because there's your interest rate sensitive areas all performing the best, including dividend stocks and staples. Or on the other end of the spectrum, the dollar strength put pressure on materials and energy, and communication services, technology struggling, continue to struggle. In fact, if you take a look at the sector comparison chart here, here is on the intraday chart, you can see they were up all day long. Even during the bounce, they maintained their strength. There's staples, there's real estate. Utilities gave back some, and financials rallied by the end of the day. Technology struggling, communication services struggling, and you have materials and energy right here. These two both lagging the broad market, small losses, but both lagging the broad market, along with healthcare, which has been a recent strength lately. If you go to our blog, remember the sector selector rankings were updated over the weekend. Brandon updated those. So here's the sectors ranked in order of their rankings on our proprietary sector selector tool. You can see utilities, energy. I mean, both. You can see kind of where the strength is, and you still got some weakness. The staples really helped. Had a good move today, getting it above 20. But discretionary and real estate, you see how much they're lagging. They had a decent day, almost a piercing line on discretionary there. Financials, materials, both below the moving averages. Staples, technology, also below the moving averages, and communication services, all the rest of these up above there, and utilities having a really good bounce to get up above its moving average. So there's your strength, and you can see where the weakness is. But that the staples and real estate have been lagging behind because rates have really hurt them, and both of them really bounced up sharply off some oversold levels. Maybe a sign that this big run that we've had in yields. In fact, if you take a look at a long-term chart of here, let's do on here. I wanted to show you really quickly. Let's go to look at a long-term chart of TLT. You can see the volume we had last week on TLT was very high. That's 3 standard deviations for the last 5 years. When you look at the volume of the last 5 years, that's how big a move. In fact, it's the highest level. We were at, 70. Where are we at here? 70. I'm looking over to the left. 82.6 million, 82.7 roughly. Over here, we were at 83.6. So we just had 1 million more shares trading over here, but this is, we are right back at those levels, and you can see we had a week and two, and then that set the low, and we bounced, not very much, but we bounced off of that low. We have opportunity to hit some support here on TLT and bounce again with such a sharp, extreme amount of volume here. If you look at on the 1 year basis, we've had multiple days of really sharp volume starting back on the 1st of October, and then this big sell-off coming with a lot of volume, way more than average, and like I said, up to that 3 standard deviations. All right, for our trade of the day, trade example of the day here, we got a stock that looks very similar to the broad market. We had this intermediate pullback. There's the old intermediate high point for this run. That's where we peaked. We pulled back. We bounced to a new high, and you can. If I were to draw my extensions here from this intermediate low, from this intermediate low up to the high, and then now to this pullback, you can see we pretty much got up to the 78% Fibonacci retracement, came a little shy of it, just a smidgen shy before pulling back down to now the old high point. You can see it better here, sitting right on that old high point. If I were to draw Fibonacci retracement levels, not extensions, but retracement, then you can see we're sitting right at the 50% Fibonacci retracement. On a closing basis today, we got 3 green arrows, we got 3 red arrows. Here, let's go CRM. 3 red arrows with a decent amount of volume. What that tells me is there's opportunity that we can bounce off of this. That's 3 red arrows, an indication if you were trend trading this and move a stop order up. You can see when we got 3 red arrows here, that set the low point and we bounced. That set the low for the intermediate pullback, and we bounced off of that. Could we do the same thing here? Well, that would be very speculative to do that. So we'd want to make a trade that gives us a good return for a little bit of risk, knowing that if we broke through, especially if we broke through this Fibonacci retracement zone, the 50% lining up with that old high, the 62%. So if we were lining up with that old low point there, in fact, if you see on the Bollinger Bands, you can see there's a volume node at the Fibonacci retracement zone. If you break through that, it's done, right? The trade's done. And when you look at the seasonality for, let's go to the seasonality here for prices percentage. There we go. Here you can see that we are in a seasonally period of time over the last 5 years at least, right there, 5 years. That we have a pretty decent run from 14% gain for the year on average to a 24% gain. So there's an opportunity for a bounce on this stock off these support levels. And what I did is I drew a line there, I duplicated it here. So what that line gives me now is a target area of where we think this might go to. If I were to pull up CRM, if I were to change the chart to show more bars off to the right, you can see there's that line. You can see the start and the end point of the trend line, the end point being 160 by 11:14. So it's not new highs. If we were to, this seasonal run will get us up to 160 according to just a duplication of that move. If you look at the current options, that would be right before these options expire. If you were to buy the at the money option at 560 and the stock made that move by November expiration or a day or two before, then that option would be be at 160. So you'd have $10 of intrinsic value. You pretty much would double your money on that, knowing that if we were to break through, then we wouldn't be in the trade anymore. Kind of a very speculative trade, anticipating maybe a day or two of messing around here in the support area before bouncing, knowing that if you broke into this area here, you broke through that volume node on the Bollinger Bands, you broke through that node right there and you broke into this area where there's a vacuum of volume, then good chance we're not going to get to that 160 level. Just close out the trade. You can put a stop order at 50% like normal. That would give us about a 2-to-1 profit loss ratio. But even if we don't get down to 260, for example, if I were to do the Theo price, there's the 160 move by 11:14. It gets to $10. But let's reset that. And let's say tomorrow or by Wednesday, let's give it a couple of days. How far does the stock have to drop for us to get to 260? Well, they have to drop pretty much $7. See the Theo price at 258 here. So it'd have to drop a little less than $7 down to 142. Well, 142 is right here. So yeah, I'd have to break through that Fibonacci retracement zone. We take our loss, we move on to something else. But we have an opportunity for a small loss and a good reward potential compared to the risk that we'd be taking in that trade. About a 2-to-1 profit to loss ratio. All right, so that wraps us up for today. What do you think? And now I want to hear from you. Click on that link above the video if you're watching on our blog. That takes you to our Market Outlook forums on marketscholars.com, where you can communicate with our Market Scholars community about tonight's video, about anything in tonight's video. The posture, what's driving the market, our trade idea of the day, any questions or comments you have on any of that, let's share with each other in those forums. Of course, if you have any questions or comments on anything that you want to talk about that's not in the video, you can throw that in you can open up a comment for that as well, or a thread in the forum for that as well. As always, thank you very much for watching tonight. I appreciate your time. Remember to subscribe to our YouTube channel, click the thumbs up icon, and comment. Follow them on Twitter for more content like this. Join our community on marketscholars.com. Join our Market Outlook community on Facebook, on our Facebook page. Have a great rest of your evening, everybody. We'll see you all next time.